With the Dow and the Q and the NASDAQ and the Russell and everybody at their all-time highs, when a world event affects those markets, how are we kind of protected when in the smaller equity portions that we're in? I mean, how do you look at that? And do you bother looking at a Korean Peninsula kind of thing and react to it?
Can I make, before you jump in, because I know you want to take this one, Rob, one quick comment when you talk about these indexes being at their all-time highs. That's including dividends, and they're only back to, for example, the Dow and the S&P, where they were at their peaks in 2007. But when you remove dividends from that equation, on a price basis, the S&P is pretty much exactly where it was back in 2000. There's been no price increase since 2000 on the US market. That slide I showed earlier, and I'm not sure if you missed that, Rob, where it points to the US, over the last 12 years earning pretty much a 0% return. That's why we think there's an opportunity there.
We're not big tactical asset allocators, so we're not trying to time the market. And it's very hard to tell when you could have some kind of systemic risk hit the markets. I mean, if North Korea decides to launch missiles against Hawaii or Guam, personally, I don't think that would actually impact the market that much if they actually were able to hit Guam. But I think one of the things we can do is we have cash in our portfolio, so we can alter the cash weighting. Because most of our assets are managed in pools, that enables us to make quick moves if we need to. And typically, again, we don't, but we have the ability to do it very quickly. And a lot of the names in our portfolios are very liquid, so we would have the ability to actually shift very quickly if we want to. I mean, and Sean is one of our main traders. I mean, he might disagree, but I think we could liquidate our entire Canadian equity portfolio in a day if we needed to, quite easily, probably before Sean goes for lunch. So very liquid. The other thing we can look at doing in a portfolio is we can write more call options, and we can buy some put options if we so choose. And right now in our portfolio, because we're more bullish on the market, though I agree that markets have been on a good run, and we actually have built a bit more cash in our portfolio, but we haven't written as many call options. And we may start to do a bit more of that in the coming weeks, because we think that maybe you might have a bit of a breather in the markets. But overall, there might be some volatility, but I still look at it, and I look at where bonds are, and I look at where the opportunities are, and I still think with an improving U.S. economy, equities over the medium to long term are the better risk-reward vehicle.